Hey guys, happy Monday. It's Harry Swaminathan. Wanted to just have a brief discussion on our gold trade. And if you see, we've on the short call, we have the short call at 164. So we put the long call at 163 when gold was, the GLD was at around 158. I think it's dropped down to 152. And so we added a 164 short call first, and then we made $2,300 on that trade. We closed that, then gold moved a little bit up, and so we opened it again, and you can see it's now up by 760. So if you include the previous trade's profit and this trade's profit, that's about $3,000. And if you add what this long call is worth right now, it's worth $670. So we would have picked a total 3,670, which is obviously a little bit more than our loss. So this is a trade that went against us, and we wanted to try to make the best out of it. So in a situation like this, we've been able to recover. If we close this whole thing out today, we'll recover the entire loss and then some. But of course, after commissions and everything, you may not have made any profit. But the point was, we were down and we came back to break even. So, which is always a good objective for a trade that goes against you. If you can come back to break even, that's great, because that's the beauty of options, that you're able to do that. If you were just dealing in stocks, you wouldn't be able to do any of these strategies. So, at this point, you could take this off. Now, and since, many of you have mentioned already that the focus has to be on learning rather than really making some kind of a fixed absolute return in terms of percentages and things like that. So, I want to try to keep this service more focused on the learning part. And so, hopefully you guys can learn. If you have any feedback, please do give me, because ultimately this service has to benefit you guys. So, I would welcome any feedback, good or bad, because my only goal is to make this, service better for you guys. So what I'm going to do is, instead of just closing it, closing it is a perfectly valid strategy at this point, because you've recovered the money. We were down about $1,000 when when gold first went down. So we were able to come back to break even, which is great, and that's a perfectly valid objective. But if we wanted to do a little bit more, then what I'm thinking is, let's try to squeeze out some more profit out of this thing. So right now, if you see, this is a bull call. So we have the long at the 163, and the short at the 164. So I'm thinking, since gold is on a negative trend, and these macro issues, and sure, gold might bounce back one day, but to what point? It may not bounce back all the way to 160 or 161. So what I want to do is turn this bull call into a bear call. Again, if you have this trade on, and if you closed it, that's a perfectly acceptable move to make. But if we wanted to learn and see what we can do with this trade, let's go over to our Analyze tab, and I do have something set up here. So if you let me uncheck it first and look at our risk profile of the existing situation. So this is the bull call, but our stock is right here at 152. I think we put it on when it was near 158 or 159, and then since then it's been coming down. But what we've been able to do is sell a couple of short calls and make up for what we lost. And we did that. So now it's at 152. Now, instead of a bull call, I want to turn it into a bear call, perhaps at 161 or 160. So I've got the 160 here. So what we would do is buy, instead of 20, we need to make it, instead of 10, we need to make it 20. We would sell 20 of the 160s right here and buy back our 20 of the 164. So we've already sold, we have a position on 164, and that is, we have a short position of 20 contracts. So we would buy that back and sell 20 of the 160s. And in this process, we are going to collect a credit, a net credit. Okay, so after paying for the 164 call, we would collect a net credit of 39 or 38 cents. So let's see what that does to our risk profile. All I need to do is check this trade here, and boom, we've turned it into a bear call. And what would be our max profit is a little tough to calculate because we have all these losses here. But you see, right now our position is showing a loss of 2,700. That's mostly coming from the long call. But what it doesn't calculate, or what it doesn't take into consideration, is the fact that we've already cashed in about $2,200 or $2,300 on this trade, and it doesn't take into consideration that. So that's why it's showing such a high number. But the way we have to read this is that from a negative of 2,700, which is what it will show right here, we would be able to come back to a maximum negative of 2,100. So basically, we would be capturing another $600 if gold doesn't climb up to 160 in the next 40 days or 45 days, how many ever days are left. So hopefully you've understood this trade. If you have, if you didn't, you can send me an email. But again, this is, at this point, we're just trying to see, what is it that we can do and what is it that we can learn. So, this trade is mostly focused on that. But the only thing is now we are converting it into a bear call. So remember, so now it's going to become a credit spread. And because of all these numbers have changed a lot, you're actually going to increase your risk on this side. So I wouldn't recommend you put it actually, because gold might make a move up and you really don't want to be messing around with this position. But I'm going to do it here just to show you, some things that you can do with this trade if you felt that you wanted to squeeze out a little bit more profit. I mean, at this point, gold is looking bearish. So it doesn't seem to be too bad of a trade. And even if we keep it on for a week or so, we'll probably get quite a bit of time decay on this. So I'm going to put it on, but I won't recommend you put it on. This is just for educational purposes. Also wanted to give a quick update on the Google trade. Google is up again $6 today. So Google's at 812. And if you recall, we had a bear call at 820, 830. And then we added 2 contracts of the long. So now what's happening in the Google trade is it's moved up to 830. Let me go back to the monitor screen. Yeah. So it's moved up. So the long call is making, the in the money call is making money. It's up $1,000. But of course, our short call, our bear call spread is still losing. But, you can see that we still have a positive delta of, doesn't show the it's not showing the Greeks for some reason. We do have a positive delta on this, but not oh yeah, it's 33. We have a positive delta of 33. And so Google's starting to move up. Well, it's at 811. So if you look at the risk profile of Google right now, this is what it looks like. So if Google moves up to 820 right here, we'll be capturing our maximum profit. So there's 11 days left on this trade. And if Google moves up a little bit and goes up to 820, we'll capture a nice profit. We'll capture a profit of about $3,000. Right now, of course, the position is at a loss of about $800, and we'll capture a profit. So I don't think we need to make an adjustment, but again, strictly looking at it from an educational standpoint, what we might want to do is take off 1 contract of the 820. So 820 is our short call. And if we take off 1 contract, we'll be short 9. Of course, we'll book a loss on this 1 contract, and let's see how much that loss will be. That loss is going to be, right now we have for 10 contracts, we have a loss of about 3,500. So we'll be booking a loss of $350 on 1 contract. So that's okay. It's not too bad. But the question is whether we want to adjust it right now, or maybe in a day or two. If Google continues to go up, then we'll take off maybe 1 or 2 contracts. I think we'll let it be for now, but the trade would be something like this. If you take off 1 contract, and if I check this, then look at the graph, then you're giving yourself much more room for profit here. Now the profit will be 3,700 if Google expires at 820. But by taking off the one contract, you're actually moving your break even also a little further. So you'll be moving it to 824 instead of 821. So that is an adjustment we can do. I don't know if you want to do it today. Maybe we'll take off one contract today. We'll book a loss of $350 on this on that one contract, and then if Google moves up some more, then we can take off another contract, and that way we'll be pushing out the break even over to the right side. And what we'll do is I'm going to take off one contract of this, and that got filled. So now our position is this way. So, we've moved it over to 824, which is good. And if Google continues to move up, it's actually will be moving into our profit zone, and time decay is going to start kicking in quite a bit. So, we should be okay on this trade. So that's what I'm going to do on the Google. I already did that. So, oh my goodness, I sold one. I should have bought one. I need to change that. So I'm going to buy two. I'm going to buy. I'm going to buy two. Buy two at 7. Okay, so that went through, and now, if we look at our risk profile, it's moved up. The max, the break even is moved up to 824.63. So this is good. So now we have $13 on the still left to go to break even. And if Google continues to move up, we'll actually be moving into the profit zone on this trade. There's only 11 days left for this trade. So yeah, there's only 11 days left for this trade. So, we should be okay as long as Google moves up. If Google starts moving down, then we'll book our profit on this 780 call. So that's what we'll do on the Google trade. Thank you.